Are you thinking about selling your shares? Be sure to avoid making this technical mistake. I'm a qualified accountant based in London, and I help people deal with finances and tax. People who have invested in shares or in property are not working people, and this is according to the current UK government. So, this is a strong indicator that taxes are probably going up for you. So, don't blame you if you are thinking about selling your shares or if you've already sold them to avoid these tax changes. In fact, this is a popular tax technique which is called crystallizing your gains. But it is important that you do this properly because the relevant rules can be quite complex. So far, I've managed to resist my urge to engage in budget speculation. There is so much going on and there's a lot of misinformation. However, there are some strong indicators to help predict what's coming this week. So I'm going to focus on shares in this video because I've been busy dealing with a few cases where people have sold significant amounts of shares. The stock market has been particularly generous, especially in the last couple of years. So if you've built a nice portfolio of shares, you might be thinking about crystallizing the gains to future-proof them from these tax changes. Even if you don't need the money, you might still want to crystallize your gains to take advantage of the current low rates of CGT. However, there are bread and breakfast rules which can be applied if you're thinking about reinvesting your money within 30 days. In the world of tax, you could be seen as selling something that you don't even have. When bread and breakfast rules are applied, and it is more common than you would like to think, we come across this on a weekly basis, the original disposal and the cost associated with it will be ignored. And the cost of sales for your disposal will be the cost of the new shares, which is your reinvestment. This means that although you've done all the work and you've sold your investment, the real tax advantage is either zero or it's significantly less than what you planned. One example that I can think of is of a corporate employee. She worked for more than 30 years, same company. The company went public and she has done well as a result of it. She has never sold any shares and just accumulated them over the years. Now there is a large seven-figure gain in her portfolio. And she's hoping to pay 20% in taxes, which is still quite a lot, by the way. It's more than £500,000. However, if she buys back the same shares within 30 days, the cost of sales will be the purchase price of the new shares. This means that although she has sold her shares, the taxable gain, that seven-figure sum that I was referring to, is still being carried forward. That's not resolved. And that could be subject to the CGT rates which the government is about to announce. And it's likely to be higher than the current rates. So you should consider waiting for more than 30 days after selling your shares and consult with your accountant to avoid any surprises. Every case is different, so you should get professional advice that is structured around your circumstances. I hope you found this video useful. Like and follow to stay connected. And remember, there are a lot of fake accounts in my name. I will never message you directly to sell you any investment opportunity or crypto, and I won't reply to your comments with an investment opportunity. Stay safe, and I'll see you in the next one.